morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series with leading investors on how to invest in the era of financial repression, I have Ira Harris joining us here this morning. Ira's been a member of the CME since 1977. He's currently with Vine Street Trading and well known in the trading community. Welcome back, Ira.
Thanks, Gordon. It's a pleasure to be here. It's an honor.
It's always a pleasure to have you, and there's so much to talk about. So I'm going to just jump right in. So we do have time. The last time we talked, we were talking about the yield curve, and specifically the 210 curve. And I have it up here. And you were warning us. You were saying, "Look, I think this thing, we had a triple bottom. It's testing. It's going to break." And you were right. It did. Looks like we have another temporary bottom. I don't know if it's temporary. What's happening? What's going on? How do you explain it?
Well, I'm glad you brought that up. And I think that level that we're going to look at now, because after we took out that previous level, I think we were talking in the maybe 120, 121 basis points. I think we're trading 95 or 96 now. The big level is going to be that 75 area, 75 basis points. But we've already taken out the lows that were made, I think, in late 2007, 2008. But what it reflects is that the Fed has a predicament on its hand because it's flattening as they're talking about raising rates. And this week especially, we've heard more conversation about what's going to take place with the rate rise and, June is live and June is live. And with this, the flattening is coming. Now, Stanley Fischer's speech yesterday in New York was kind of interesting, very highly sophisticated. That's why the media really didn't cover it. He discussed new Wixell and all the responses to it in an effort to build up the importance, of course, of Michael Woodford. But this is what's critical here. And this is what professional traders and investment people have been struggling with, which is, to me, really reflected in why the poor hedge fund performance, because we've seen things that we have not seen. Now, usually, with this flattening of the curve, it's 210, we're talking about, which I call, of course, the investor's curve rather than the speculator's curve. But that flattening would indicate that, number one, rates are either too high or going too high on the short end, relative to what the market perceives is the potential growth, of course, in the future. And they're getting nervous. Now, usually I would say, well, this is a very solid indicator and that the Fed has really waited too long and they ought not to do anything here, which, of course, flies in the face of everything we've heard for the last 2 weeks, especially from the various Fed presidents. With saying that, there is a dynamic in play in the global markets. Because don't forget, with the vast amount of central bank purchases, QE programs, QQE programs, whatever, they have skewed the markets so badly that the markets are trying, and I know we've discussed this, that they're trying to get a read on what this all means. But because everything is relative value, and as Bloomberg, Alexandra Harris, who's my daughter, who is at Bloomberg, wrote a piece a couple of days ago or a week ago discussing about that 60% of the developed market bonds are in negative territory. So that skews everything. So it makes U.S. 10-years, even with everything that might be going on, the 10-year yields may want to go up. But they can't because the relative buyers around the world, from pension funds to hedge funds they won't let it. So that we can't get a real feel for what this curve means. If that's the reason that the curve is flattening, then we're in a whole different new ballpark because it's a global, of course it's a global phenomenon, but the power of it we've never seen before. And that's going to affect everything. Because it breaks the Fed's own signaling mechanism. Because does the Fed know whether it's too tight or not? It doesn't know. It doesn't know because the rest of the world will allow it. Now you could say, well, everything is fungible. But I'm not buying that. Because bond markets need to be a signaling mechanism to be effective. And if you've broken the signaling method, well, we're flying here in uncharted territories. There's no real maps for this. And you know what? Then it becomes a question of who's in the pilot seat. And that's what the world is, to me, trying to figure out. Do the people in the pilot seat know what they're doing and have confidence in what they're doing, or are we really flying blind here and really don't know the way this is going to play out?
Well, we know we're mispricing risk. We know we have a lack of price discovery. There's all sorts of things, from extended periods of this, I'll call it monetary malpractice, for lack of better words, that this is the kinds of distortions that we should expect.
So those who have enough gumption, so to speak, that's where they like to play, and that's been actually flattening more because they seem to be able to even exert more pressure. But that may also be reflective of relative value, because if I go out on a 30-year and I can buy the U.S. 30-year and get a 2.7 yield, 2.65 yield, relative to the rest of the world, they just did 50-year. Spain, I think, did a 50-year for 3.2. It's preposterous. But in a yield-starved world, yield-starved because the central banks have so dynamically shifted everything through their massive purchases, people are stuck having to really reach for things. So the 530 is more dynamically telling me that the Fed may be erring in raising rates, that they waited too long, and that the global economy, the threat of China, Europe, people who do analysis in Europe they crack me up. They bring tears to my eyes and they make me laugh at the same time, because they applaud 3.3% GDP growth. Like this is something. It's not even enough to cover their budget situations. It's preposterous. Europe is in a very, very difficult situation here, and that may mean that the Fed has waited too long, and that, to use Janet Yellen's and Fisher's words, the headwinds just may be too great to exact. And that's what, as my friend Bernard Connolly would argue with you, that's what she's looking for. She's looking for reasons not to. We hear from the Fed presidents, but of course those are regionally based, and for whatever reason they now are out there squawking a little bit more, sounding a little more hawkish. But the Fed governors, the FOMC governors, meaning Brainerd, Stanley Fisher, we have to put Dudley in there, and Janet Yellen, and they're not as hawkish.
Dudley was pretty hawkish here yesterday, day before, at least on his press conference.
You're right, but the previous day he was a little more, he's been all over the map. He's like the balancer between the two. And it's like, who gets these orders? What are they speaking about? What are they speaking from? As again, I'd say it was a lot better. We were a lot better off when not everybody knew who the regional Fed presidents were, and that they weren't running to every microphone to make their case about something.
Ira, switching gears a little bit, and we were talking just prior to starting to record here about what might have went on at the G20 last G20 meeting in Shanghai, China. Now, as we're talking, we've got another G20 finance ministers meetings going on, but specific to how it's impacting the yuan and the yen relationship.
Well, we're having a G7 finance minister meeting in Japan as we speak, and next week the heads of state from the G7. It's not the G20. It's just it's the old line clone.
G20 was the last one, but this is the G7.
Right. This is a much smaller group, and I know you were talking, and rightfully, Jim Rickards, certainly a voice of reason and high thinking, and somebody who I hold in high regard. I just finished reading his book on his new book on gold, which much I agree with. But it's people can compare it to the Plaza Accord. I think that's very off base. I just don't see it because it's just not it's not relevant. That was a major thing. I don't believe anything major came out of Shanghai to that extent, because I've been around this business a long time, and nothing could have been kept that quiet. Now, when you look, we were laughing, but there's that famous picture, because it's always a photo op for. And Janet Yellen was there, and she has such a look on her face that, like, she had to swallow something that she was not happy with. I mean, I think Ambrose Evans Pritchard had written about that picture, and maybe something did take place. But I would compare it, as I told you, more to June of 1998, when the Chinese were much more concerned, because at that time there was a depreciation of the yen going on, fairly sizable. And Bill Clinton, Beijing, he was going to Beijing because that was his first sense of that pivot to China, where they were trying to open up more relations. And 2 weeks before he goes, Bob Rubin makes a speech about the strength of the dollar and how the strength of the dollar is good, and that's our policy. Because you don't forget, it's the treasuries, and he was the Secretary of Treasury, it's the treasurers. Bailiwick for the currency, not the Fed. So, but then Bill Clinton's headed to Beijing, and a few days before he leaves, or right when he's leaving, the United States Treasury starts buying yen and selling dollars. Totally in contravention of what Rubin had talked about, and it was really an embarrassment. And everybody, people in real time who I talked to, it was because so many people were caught off guard. Some of the biggest hedge funds were all short yen, and they got fairly decimated because it was such a surprise. But that it was done because the Chinese were concerned, were having at that time the beginning of the Chinese manufacturing miracle. And they were upset at the recent severe weakening in the yen, or it wasn't, throughout the whole following the Asian contagion, which started in July 2nd of 1997 with the depreciation of the Thai baht. The Chinese, then the yen starts to follow later, about a year later, or not a year later, I'm sorry, about 6 to 9 months later, it starts weakening, and the Chinese were very upset, evidently, about it, and put pressure on the U.S. to try to correct the weakness in the yen. So it was a real shot across the bow. Now, out of Shanghai, 2016, February, we get the sense that the Chinese were displeased with the recent 30% depreciation of the Japanese yen and made their voices known, which ties back to the August 24th, that weekend in 2015, when the Japanese intervened in the currency market and roiled global markets. So if you tie that into Shanghai, you can pretty see that the Japanese sent a signal that, hey, when we have displeasure, and because we're an autocratic government, we can move in a very quick, dynamic fashion. And when we move, we're going to disrupt the markets. So you better take care of what this yen situation is, because we believe that the yen is too weak against the yuan. So did that take place? May well be, because I can put up a chart and I can show weakness in that cross, of course, as the yuan weakens against, or the yen, vice versa, strengthens against all currencies. But now, of course, now the Japanese are unhappy. So this will get interesting with the G7 meeting, because the Japanese have voiced their concern about how unhappy they are about the recent depreciation of the yen. So what's the word that they call it? One-sided. It's a one-sided appreciation. And in fact, last week and early this week, Jack Lew, the U.S. Secretary of Treasury, again admonished the Japanese not to be so vocal and be out there trying to undermine their currency.
Well, we've certainly seen the appreciation in the yen, not just against the yuan, but across currencies since February, and in the euro. And I'm wondering, you want to speculate on the G7 meeting, because I know Italy's facing serious issues here right now, and it's sitting there between Drahi controlling the euro and it getting stronger, and the yen. On the other hand, what do you think might come out of the G7 meeting?
I don't think much, because they've got some serious, as you say, issues on their plate. You know, they're worried about Brexit, so we'll hear some statements to support David Cameron, who's opposed to leaving, and they'll talk about the importance of that. So we'll see some of that. We'll get some comments about, that currency manipulation does not take place to attain some short-term trade advantage. We respect monetary policy, of course, has to be domestically based, but if we feel that it's directed to weaken one currency, because with saying that, and this is they'll warn the Japanese, because the Japanese can certainly seriously weaken the yen if they started buying other countries' bonds. So if there was a concerted effort by the BOJ to buy U.S. treasuries, to buy European debt, that would be, any time a central bank intervenes in or starts buying somebody's assets in a very aggressive manner, that's being done to weaken your currency. There's no better way. Nobody does it better than the Swiss, or at least, so we thought, but even that got expensive for them. But they're still doing it. The Swiss are actively interveners in the market. The Swedes are interveners in the market. The Norwegians, their sovereign wealth fund, can always maintain a stability. But if anybody were to aggressively, like the Japanese, if the BOJ were to say, oh, we're not buying JGBs because there are none anymore, we're going to buy U.S. treasuries, I guarantee you the dollar-yen, meaning that the yen would weaken dramatically, because that would be a central bank policy of directly weakening their currencies by buying other countries' assets. They will be warned against doing that. But will the Japanese retailer investors, that's a whole other, and the pension funds, because Japanese pension funds are under a lot of pressure to deliver some modicum of return, and with negative rates in Japan, hampering their ability to achieve a positive return. It's a problem. It's a problem for the world. So they're not going to come out of anything. And what I think the biggest issue that the G7 will speak to is what I will call the Larry Summers agenda, which he has been promoting around. And I think we talked about it last time, is that he's trying to get a global fiscal stimulus, that everybody gets on board to bring forward all their infrastructure spending now. Kind of it would make the Chinese very happy. They won't be at the meeting. They may be on the sidelines, but they're not in this meeting. But there certainly seems to be a desire to craft some type of global fiscal stimulus to take the pressure off of monetary policy. And, monetary policy will, of course, stay at the zero bound even when they initiated this, because, again, this is legislative. You're not, if Obama was in Japan next week and said, oh, we're going to do it, he has to go fight his way through Congress. It's the same with what will happen in Europe, because they're pushing the Germans, who are sitting on the most immense pile of cash, because as people talk about the Chinese, the Germans are much more a propagator of current account surpluses, but they save and save and save, which is, of course, as we've talked about, it becomes a real problem in Europe anyway, because the different needs of everybody. How do you make monetary policy for 27 countries that all have different needs? So these will make their way. So I think that we'll hear about, we are totally opposed to nations using their currencies to gain a trade advantage. There will be a lot spoken about the need for fiscal stimulus. Now, Canada, who's a member of the G7, with Justin Trudeau, I don't know that people remember this. He was kind of surprised that he won, and he won handily. And who was his economic advisor going into the election but Larry Summers? And Justin Trudeau ran on a platform of fiscal stimulus. So, and having him won, so there will be a lot of this discussion. The problem is Europe, because Europe is 27 different situations looking for a common policy, and there cannot be a common, it just can't possibly happen. Because look at Germany now. I have a piece of paper sitting on my desk, as long as we're talking about this, put out by MNI, which is owned by the Deutsche Börse. ECB sails into deceptively calmer spring waters. And it's from John Payton, and it talks about, Germany has full employment. Well, how can Germany if Germany has full employment and it has budget surplus, current account surplus, and it sits there with its interest rates at negative numbers, no, it can't be. Then everything that you've told me is wrong, or the EU is totally a dysfunctionary. You want to talk about dysfunction families? This is because what has to happen is you get very robust inflation in Germany because you're keeping rates way below whatever metric you want to use. Yesterday, Stanley Fischer, of course, talked about the natural rate and the neutral rates of interest, using Wixell's work. And what is that rate? Well, it can't simply apply to Germany. And your work is in financial repression. Nobody in the world right now is being more financially repressed than the German people. Nobody. Nobody. And this is a serious problem. And they're carping at Draghi. The AFD, but there's other rising voices. And we missed one thing. We not only have Brexit, the G7, we have elections in Spain, and we have the German Constitutional Court again ruling on these OMTs, the outright monetary transactions, and the ability of the ECB, are they overstepping their bounds and actually performing fiscal policy through their monetary policy. So the German court in June is going to visit this. So it's one more of those elements, and really it is so badly broken. And the German people are, as we talked about, the first one that I think we ever did, that this was coming, and it's coming. And you really have to be totally sleeping and unaware if you don't sense the great political dynamics taking place in this. But the markets are complacent. There is a complacency. Right up in front of me, as we're talking, I have, of course, my screen, and I'm looking at the European bond markets. And the European bond markets have yields that are preposterous. Why? Because the ECB is in. We just talked about how strong Germany is. And Germany is Europe's credit card. The ECB, yes, they can print money, but they have no credibility without the German credit card. Who would buy European debt? Somebody has to be guaranteeing it. There is no Euro bond. It doesn't exist. George Soros keeps pounding the table that they need it. Other people keep pounding the table they need it. But in order to do that, you have to have a credit. You have to have somebody guaranteeing that credit. And guaranteeing that credit is the Germans. The European debt isn't, look at Greek debt, which is questionable, is still at 8 or 9%. 8 or 9%. And that's with all this other ECB intervention and movement. So this is going to be the wild cards going forward. And for markets, they are not priced to it. They have swallowed totally the concept that the ECB is some type of brilliant organization with the creditability. The ECB does not have the creditability. It has X amount of balance sheet assets, which are now growing tremendously. So the game is to take on all this debt. And you see the way it plays out in the world. You take on all this debt, and you basically, then you tell the Germans, well, you stand behind us, and the Germans go, no, we don't. You want to talk about a global crisis? This would be equivalent. The ECB would be equivalent to credit credit, that started really the Great Depression in 1932 Austria, when the credit, when that bank went under. Now, the ECB sits in that role, because if the Germans said, no, it's over. We are not going to do this. We are not going to perform to this. We are not guaranteeing it. The world blows apart financially. What the outcomes are, I can't tell you. But so they're hoping to pile all this on so that the world can say to the Germans, no, you can't. You can't leave. It's like in one of my favorite movies, Bronx Tales, when they lock the doors and they go, now you can't leave. And that's what the Germans are. This is such a surreptitious way of capturing this and forcing them to basically be the guarantor. And that's the drums that are starting to rise, because every month they're buying 80 billion more euros worth of paper. They don't even have it to buy. They've had the U.S. corporations are coming over there and floating debt. And who do you think's buying it? The ECB, because they need product, so to speak.
Corporations are floating bonds in Europe right now because huge, exactly, because there's 20 billion euros a week going on. It's 80 billion a month. I mean, it's of course you're going to take an opportunity to do that.
Absolutely, and so therefore it's really undermining what Draghi. He's a consummate liar. But you know what? It's the definition of a diplomat is an honest man sent abroad to lie for his country. Draghi's a consummate liar because he has to be, because he's trying to juggle the unjuggable. And he's been a fox at making it work. You have to give him credit. But it ultimately resides in the hands of Germany. And what is going to happen there politically, because it's shifting. And those are powerful shifting winds. And so they're in a hurry to pile on, keep piling on to the ECB all this debt, because they go, well, if you leave, let's go back July of 2012. Italian 10-year notes were 7%, because this is when they were worried about the European Union blowing up. 7%. Spain, 7%. Greece was off the charts. France was, these levels were so much higher. And that's what prompted Draghi to say, whatever it takes. We'll do whatever it takes. And the market accepted that. And over the course of whatever it takes, they keep piling on this debt. But again, I asked the question, who's guaranteeing the debt? And until somebody answers that question, who guarantees the ECB debt? It's all whatever.
We have to break our great conversation. I would make a point that from what you said a little bit earlier, and we fully agree with you at the financial repression, we've come to the conclusion infrastructure spending around the world, but certainly no matter who wins the U.S. election, whichever party, we're going to, and around it, because it's being propagated by Summers and others, is getting real traction. And so the central banks' balance sheets will increase, and the way they can sell it to the public will be infrastructure. We see water problems in America and Flint. We see airport problems around everywhere we turn. We're getting amazing coverage on our infrastructure problems that are going to lead us to accepting a couple trillion more money on our Fed balance sheet. That's the conclusion we're coming out of at the FRA in looking at investments going forward. Not investment advice, just observation.
Look, and we'll finish up there. If you want to see an accord, there's going to be a fiscal stimulus accord. There's no, the war drums are beating. You can hear it. And of course, now you got, quote unquote, Donald Trump, the builder, the great builder. He's smart enough to realize where those drums are. And this is about, what role is Larry Summers going to play? I will tell you this, and I know we're going to end here. Whenever I see Jamie Dimon interviewed, I would if I was a media person, I would ask him this question. Is the worst mistake you ever made preventing Elizabeth Warren from being the head of the Consumer Fraud the legislation that she basically wrote. Because, Obama had put her forward for that. And I believe that Jamie Dimon and that powerful bank lobby, especially when Geithner was there, went and they queered that deal, in which Elizabeth Warren got angry enough and ran for Senate, and now she's got real power. Because Larry Summers would have been the Fed chairman had it not been for three people, Elizabeth Warren, Sherrod Brown, and David Vetters, because they were lined up against him as being the consummate Wall Street insider, and Elizabeth Warren was not going to, and the White House backed off. Because all we did was hear Summers, and that's the job that he wanted. He'd already been Secretary of Treasury, he's been head of the Council of Economic Advisors. What job could he possibly want? So I believe he's positioned himself. It'll be a lot. I don't know that they can overcome Elizabeth Warren because her disdain for him is great. So, this is my theories. What do I know? I don't, I'm just a guy who tries to pay attention to the world around me and see these things, but that's what he wants. So that would be the interesting.
Have to break. I always enjoy our conversations. Have a good weekend, and we're going to talk again.
Okay, thanks, Gordon. Appreciate it. Thanks for having me.